Welcome to Bank Director's online training series and the unit on stress testing. My name is Mike Budinger, and I'm a partner in the risk consulting practice at Crowe Horwath LLP. Stress testing is a simulated exercise to predict how a bank's financial performance and balance sheet is likely to be impacted by an adverse event, such as an economic recession. Although it has been getting a lot of attention in recent years, stress testing is by no means a new concept in banking. Some large international banks began to use stress testing in the early 1990s. And in the United States, the OCC, FDIC, and Federal Reserve issued joint guidance in 2006 stating that portfolio stress testing and sensitivity analysis should be part of every bank's set of risk management practices for monitoring high loan concentrations in commercial real estate because of the potentially volatile nature of this asset class. Then came the 2007 to 2009 global financial crisis, which in many ways was a significant event for the industry, for the regulators, and for Congress. Today, all banks over $10 billion in assets are required by law to conduct annual stress tests. Even banks below the $10 billion threshold are being encouraged, although not required, by the bank regulatory agencies to incorporate some form of stress testing into their enterprise risk management programs. In this video, I will provide an overview of the various regulatory requirements for stress testing that are now in place. I'll talk about the advantages of stress testing and provide an overview of the various stress testing methods. And I'll detail some of the implementation issues that you'll have to consider if your bank sits below the $10 billion threshold level for mandatory participation, but you would still like to incorporate the practice into its risk management discipline. Let's take a few minutes to talk about why the regulators have placed so much emphasis on stress testing as a key risk management tool. Between 2008 and 2012, there were 465 bank failures in the United States. And the vast majority of these were small, community-based institutions, and most of them failed because they lacked sufficient capital to survive the sharpest economic downturn since the Great Depression. While it was presumed that many of these banks were well capitalized prior to the crisis, it turned out that they couldn't survive a catastrophic event that was generally unanticipated. At its simplest, stress testing is a method that uses economic modeling to assess whether a financial institution could survive a variety of adverse scenarios. What would happen to the loan portfolio if the unemployment rate shot up to 10%? What would happen if the stock market lost 25% of its value over the next 12 months? And how would that impact the bank's profitability? Stress testing can be done at a macro level, as in the case of an entire portfolio of loans, or at a micro level, as in the case of a specific loan or investment security. Most importantly, stress testing allows us to replace presumption with a reasonable prediction. For some banks, stress testing is a requirement. In 2009, the Federal Reserve began administering its own stress tests to a group of very large U.S. banks that were judged to pose a significant systemic threat to the U.S. economy in the event of their failure. In a speech he gave in 2013, then Fed Chairman Ben Bernanke credited the adoption of supervisory stress testing as a turning point in the government's management of the financial crisis because it provided anxious investors with credible information about prospective losses at the large banks, which until then had been lacking. 6 years after the crisis, stress testing has been formalized into two separate but related programs. The Dodd-Frank Act of 2010 mandated that all banks in excess of $10 billion undergo an annual stress testing regime, a process that is often referred to as DFAST, which stands for Dodd-Frank Act stress tests. Although large, systemically significant banks have already gone through several rounds of these annual Fed-administered stress tests, smaller, mid-sized banks between $10 billion and $50 billion in asset size were not subject to mandatory stress testing until 2013. Unlike the large, systemically significant banks where the Federal Reserve gives the tests, stress testing at the mid-sized banks is self-administered using a variety of scenarios that have been provided to them by their primary regulator. All banks above the $10 billion threshold are required to test for capital and liquidity adequacy and to have strong governance controls in place. Systemically significant banks must also submit an annual capital plan to the Federal Reserve for its approval and a related process referred to as CCAR, which stands for Comprehensive Capital Analysis and Review. CCAR was most recently expanded to 31 bank holding companies, including several U.S. subsidiaries of foreign banks. The purpose of CCAR is to ensure that these very large banks have robust and forward-looking capital planning processes that take into account their unique risks as well as sufficient capital to continue operating through periods of economic and financial stress. The Fed considers both quantitative and qualitative factors when it evaluates a bank under CCAR. The Fed-administered stress tests form the core of the quantitative analysis, while the qualitative evaluation focuses on the quality of the bank's capital planning process. The Fed must approve each bank's capital plan before it can take any significant capital actions like dividend payments or share repurchases. Of the 31 banks this year, the Fed objected to the capital plans of 2 banks and gave a conditional approval to a third bank's plan. Community banks are not required by the Dodd-Frank Act to perform periodic stress tests. However, the regulators have recommended that smaller institutions incorporate some form of stress testing into the risk management programs. The OCC issued supervisory guidance on community bank stress testing, and the FDIC made a similar recommendation in its Supervisory Insights newsletter, both in 2012. It's important to remember that many of the failures during the financial crisis occurred at community banks that had high concentrations in commercial real estate. A practice of stress testing could have given them important insight about whether they had sufficient capital to weather a deep recession. Other factors that have contributed to bank failures during tough economic times include over-reliance on broker deposits, as well as assets whose valuations are highly sensitive to volatility in energy and commodity pricing, interest rates, and the price of farmland. Stress testing would help small banks determine whether they had enough capital to sustain losses because of any of these factors and remain within the regulatory guidelines for capital. In 2012, the OCC issued supervisory guidance on stress testing for banks under $10 billion in assets. And while stress testing is not mandatory for these institutions, the OCC said it does consider some form of stress testing on at least an annual basis to be a key part of sound risk management for community banks. The OCC also said that a community bank's approach to stress testing should fit its unique loan portfolio, strategy, size, loan types, composition, operation, and management. The OCC supervises banks and thrifts that have national charters, but its guidance on stress testing should be of interest to any bank under $10 billion in assets, regardless of what regulatory agency oversees them. This is especially true for banks that are actively seeking to grow through acquisitions and are currently within $1 billion of the DFAST threshold. In the case of these institutions, their primary regulator has most likely advised them to adopt stress testing now in preparation for the day when they exceed the threshold and it becomes mandatory. The OCC states in its guidance that it does not endorse any particular stress testing method for community banks. The agency says the methodology can range from a single spreadsheet analysis to a more sophisticated model depending on the complexity of the bank. Regardless of the method used, an effective stress test should have the following elements. It should ask plausible what-if questions about key vulnerabilities. It should enable the bank to make a reasonable determination of how much impact a stress event might have on earnings and capital. And the resulting analysis should be incorporated into the bank's overall risk management, asset liability management, and strategic and capital planning processes. The OCC guidance says that for most community banks, a simple, stressed loss rate analysis based on call report loan categories may provide an acceptable foundation to determine if additional analysis is necessary. Banks should primarily focus on credit concentrations or loan portfolio segments that are significant to the overall business strategy. Any potential adverse impact on earnings, loan loss reserves, and capital revealed by the stress test should be evaluated, and the bank should take whatever steps are necessary to maintain a level of capital that is commensurate with its risk profile. Remember, the whole point of stress testing is to determine whether the bank has sufficient capital to survive a variety of potential adverse events so that it can strengthen its balance sheet accordingly. All of the bank regulatory agencies expect every bank, regardless of size, to have an effective internal process to assess its capital adequacy in relation to its overall risks, and to plan for maintaining its capital at an appropriate level. The OCC guidance provides an overview of the various stress testing methodologies. Let's take a few minutes to cover those because they provide a useful tutorial. Many of the most commonly used stress testing approaches fall under the general category of scenario analysis, where the bank applies historical or hypothetical scenarios to assess the impact that a variety of events would have on the bank, including some that might be quite severe. Scenario analysis can be broken down further into several subcategories. Transactional stress testing is a method that estimates the potential losses at the individual loan level by assessing the impact of changing economic conditions on a borrower's ability to service debt. Stress testing at the transaction level can help gauge a borrower's vulnerability to default and aid in the early identification of problem loans. This approach can also help banks make good lending decisions. For example, prior to making a commitment to finance a commercial real estate project, the bank could analyze financial and market assumptions provided to it by the borrower to determine whether the projected cash flows can withstand market fluctuations. This is key in assessing whether the borrower will be able to service the loan going forward. Portfolio stress testing is used to identify current and emerging risks within the loan portfolio by assessing the impact of changing economic conditions on borrower performance, identifying credit concentrations, measuring the change in overall credit quality, and determining the impact on the bank's earnings and capital. Banks can either take a bottoms-up approach, where they aggregate the test results on a number of individual transactions, or they can use a top-down approach, where they stress an entire pool of loans with similar characteristics. The stress test scenarios should include a base case reflecting current economic conditions and also one or more adverse scenarios based on both macro and local economic data. Enterprise-level stress testing takes a much broader look at how multiple types of risk within an institution might interact with each other under an adverse economic scenario. This would include credit risk within the loan and securities portfolios, counterparty credit risk, interest rate risk, and changes in the bank's liquidity position. Enterprise-level tests should also include a base case and one or more adverse scenarios. Finally, reverse stress testing assumes a specific adverse outcome and then deduces the types of events that could result in such a scenario occurring. This approach can help banks consider scenarios that are outside of normal business expectations and challenge common assumptions about performance and risk mitigation. The OCC guidance offers this example. Let's say that a bank has a highly concentrated but geographically diverse construction portfolio. Reverse stress testing could help the bank identify conditions or events that would result in losses across each geographic segment of sufficient magnitude to cause its capital ratios to fall below minimum regulatory levels. Even a simple, straightforward approach to stress testing, where you're only applying it to certain concentrations in the loan portfolio, like commercial real estate, is a time-consuming exercise. To make sure you're getting an adequate return on investment for both the direct costs and staffing resources, it's important that you integrate a stress testing process into your overall enterprise risk management program. Unless stress testing is used as an important tool in the bank's ERM program, it will most likely become a time and resource-consuming compliance exercise that might not justify the expense. As we have already discussed, stress testing, when done effectively, can help a bank's board of directors and management team forecast how various adverse economic scenarios could impact its capitalization. And as we learned during the financial crisis, the banking industry was undercapitalized and thus unprepared for a major adverse event. Stress testing can also be used prospectively by the board and management to help set the bank's risk appetite and concentration limits by quantifying the link between risk and capital. For example, if the board and management determined that always staying above the bank's minimum capital ratios was an important component of its risk management appetite statement, stress testing could help establish certain concentration limits based on the analysis prepared using a worst-case scenario. Community banks that are intending to incorporate stress testing into the ERM function should also consider whether to include other risks, such as liquidity and interest rates, into the testing process. This is required under DFAST for banks over $10 billion, and it provides a comprehensive assessment of how various adverse scenarios would impact the bank's income statement and capital ratios. For a community bank, setting up a stress testing regime is not a trivial exercise. It could realistically take 6 to 12 months to have a reasonable stress testing and forecasting process in place, depending on the scope of the effort and complexity of the bank. Ideally, a bank should start the process by taking an inventory of necessary resources to design and implement the program. Does a bank have someone on staff who can design and build the models or tools that will be used to run the tests? Or will it have to go outside the organization to acquire that expertise? It will also be necessary to pull together a small team to manage the process, and this could potentially be a full-time endeavor for these individuals. Stress testing is really a continuous process where you're analyzing results, building improvements into the process, and preparing for the next round of tests. This is not a one-and-done undertaking. One of the most crucial aspects of stress testing is having sufficient data to feed into the model. How complete are the bank's data files, and how far back do they go? A bank might have enough data to do portfolio-level testing, but if files are not complete, it wouldn't be able to do a thorough assessment at the transaction level. By necessity, the initial stages of stress test implementation could involve an extensive review of the bank's loan data to identify gaps that could have an impact on the test's effectiveness. The entire stress testing process will have to be well documented, particularly if the bank has embarked on it at the suggestion of its primary regulator. The examiners will want to be able to review what was done and how. There's an old saying that if it isn't documented, it didn't happen, and you should expect your regulator to adopt this point of view. And it'll be important to involve your internal auditing team in the process so they can verify that the testing program's approved policies and procedures are being followed. Lastly, it is important that the bank's board of directors and senior management team show their support for incorporating stress testing into the bank's risk management process because it communicates the test's importance throughout the organization and sets the right tone at the top. Let's review by summarizing a few key takeaways. At its simplest, stress testing is a method that uses economic modeling to assess whether a financial institution could survive a variety of adverse scenarios. It can be done at a macro level, as in the case of an entire portfolio of loans, or at a micro level, as in the case of a specific loan or investment security. The Dodd-Frank Act requires that all banks with $10 billion or more in assets undergo an annual stress testing process. For banks with $50 billion or more, the Federal Reserve administers the tests. For banks between $10 billion and $50 billion in assets, the tests are self-administered using scenarios provided by the regulators. Systemically significant banks must also submit an annual capital plan to the Federal Reserve for its approval before they can take any significant capital actions like dividend payments or share repurchases. Community banks are not required by the Dodd-Frank Act to perform periodic stress tests, although the OCC and FDIC recommend that smaller institutions incorporate some form of periodic stress testing into their risk management programs. The OCC states in its guidance that it does not endorse any particular stress testing method for community banks. The agency says the methodology can range from a single spreadsheet analysis to a more sophisticated model depending on the complexity of the bank, and banks should primarily focus on credit concentrations or loan portfolio segments that are significant to the overall business strategy. Stress testing can also be used prospectively by the board and management to help set the bank's risk appetite and concentration limits by quantifying the link between risk and capital. Although it is not required, community banks should consider including other risks such as liquidity and interest rates into the testing process. Setting up a stress testing process could take 6 to 12 months depending on the scope of the effort and complexity of the bank. Important steps include putting together a team to manage the process and determining whether the bank has sufficient historical data to run an effective test. And lastly, it is vital that the board of directors and senior executives support the testing process by setting the right tone at the top of the organization. Thank you for joining me for this training video on stress testing.